Being a business owner or self-employed has so many perks, but the one biggest downside of owning your own business is being able to get a mortgage to buy a home until now. See, historically speaking, it has been very difficult if you own your own business to get a mortgage. And the reason for that is when you go to a lender, they usually want to see 2 years of your tax returns. Now, the biggest downside and why it's become a challenge is as a business owner, we have the ability to expense a lot of things. And the idea around that is we want to reduce our taxable income. This is such a perk of owning your own business because we're sending less money to the IRS. But the downside when it comes to getting a mortgage is when we look at 2 years of your tax returns, we're not looking at that top number of what your business earned in gross revenue. We're looking at that bottom number after all of those expenses, which could show very little income and in some cases, maybe even a loss of income. I am a 20-year veteran helping people get mortgages to buy homes. And it happens to be that about 65% of my clientele are business owners just like you. Today, I'm going to show you 6 options that you have as a business owner to be able to get a mortgage and to buy a home. Okay, now that first option is a 1-year tax return product. And what this means is if you go to any big bank, and I won't name any of them, and you say, I'm self-employed, I want to get a mortgage, they're going to ask for the last 2 years of your tax returns. Let's say that your business had a booming year the most previous year, but the year prior to that was not so great. So if the big bank is looking at 2 years of your tax returns and they're doing an average of your income, that previous year is really going to hurt your average, which could impact your qualifying power. Now, the beauty of this 1-year tax return product is all we look at is your most previous year. So if that was a great year, we're just doing a 12-month average of that new year. Now, keep in mind, we're using your net income, not the gross. So as long as you didn't expense everything and you show enough net income, this could be a great option for someone that had a stellar year the most previous year. Now, keep in mind, for all of these products, generally speaking, you have to have owned your business for at least 2 years. Okay, so keep that in mind as I'm going through this. So let's get into probably one of the most popular or most used products for someone that is self-employed. We call that a bank statement loan. So what this means is instead of looking at your tax returns, so let's say your tax returns, that net number doesn't show enough money. I'm sorry. Okay. All right, so let's get into probably the most used or most popular product that those that own their own business use in order to get a mortgage. And this is called a bank statement loan. And what this means is instead of us as the lender looking at your 2 years of your tax returns or 1 year of your tax returns and at that net number, and let's say that net number, you write everything off and you don't show anything, is we put your tax returns inside. In fact, we don't even look or request those from you. Instead, we're going to look at either 12 or 24 months of your most recent bank statements. Now, these can be business bank statements. They can also be personal bank statements. It depends on the nature of the business that you do. More often than not, they're business bank statements. And the beauty of this is we're going to look at all of your deposits over the past 12 and 24 months. And there's a calculation that we do in order to create income from those deposits. The reason why I love this product is those business bank statements or personal bank statements that have business income coming in are a better reflection of what your business is doing. Our tax returns are not, right? Because we're writing everything off to show that we make no money. So the business bank statement product can be a great product as long as your business has consistent deposits coming in and enough deposits for us to create income to allow you to get a mortgage. Okay, now the next product is what we call a P&L loan product or a profit and loss. So what we're doing in this case is we have a third-party company provide or put together a profit and loss for you. Okay, this could be a financial advisor, it could be an accountant, it could be a bookkeeper, anyone but you putting this together. We're usually going to ask for a 12-month profit and loss for your business. We'll probably also ask for maybe the last 1 or 2 months of your business bank accounts just to make sure that that profit and loss for the last 12 months jives with the last couple months of your business. Now, again, depending on how all that stuff looks, maybe expenses aren't so much and you're showing a better net income through a profit and loss. For example, when we ask for your tax returns on that product, we go back the last 2 years. Let's say we're further into the year. So for example, at this moment in time, we're November of 2024. So we're almost through the year. You could provide a profit and loss for this year, and maybe you just had an amazing year, but the last 2 years on your tax returns were not that great. We can use that profit and loss from a third-party company and use that to get you a mortgage on a house. Okay, now the third product is a 1099 product. So for those of you that are receiving 1099 income, for example, maybe you're doing some contract work for someone and they give you a 1099. We can use that 1099. We look back 1 year only. So we would ask for your most previous 1099. We're also going to ask for a recent bank statement to, again, show that that income that you received last year jives with what you're bringing in on a monthly basis through that contract work or anyone that's paying you 1099. Now, the beauty of this is you usually are going to report that 1099 to your tax accountant, or if you're doing it yourself and you're going to start to do all these expenses. Now, with the 1099, we're not looking at any of those expenses. We're just looking at that gross number that you receive for the 1099. This also could be a great tool to allow you to create qualifying income in order to buy a home without having to provide your tax returns. Okay, the fourth product is what I call asset depreciation or asset dissipation. You might see those two and they both mean exactly the same. This is for someone that is asset heavy, so it can show that they have a lot of money in the bank. Now, it doesn't have to be just checking at savings. It doesn't have to be your business account. The beauty of this is we can use retirement accounts. We can use stock accounts, checking, savings. We can use a whole life insurance policy, whatever that cash value is. So all of your assets, we essentially are going to create an income. Now, the calculation of that income depends on the type of investment. For example, if you are using a retirement income to show some of those assets and you're not retired yet, we're going to take a haircut off of whatever's in there. Usually we'll use about 60% of there. And the reason for that is if you were to pull that money out of retirement, you'd be taxed usually about 30 to 40% for taking that out if you're not of retirement age. So we have a calculation depending on the investment. We will use that as a calculation we use for income. Now, the beauty of this is, let's say you have $1 million that we can verify in assets, is the calculation we use is very liberal, meaning we'll usually divide that over 60 months, so like a 5-year period. And whatever that number gives us is the income that we get to use to help you qualify. So this is a fantastic product for someone that is asset heavy and can verify those assets. Okay, number 5 is what I call ATR, or ability to repay. This is a very, very cool one. Similar to the asset depletion product, but even easier. So this is someone that has good assets that we can verify. So let's say you're trying to buy a home and the loan that you're trying to apply for is $800,000. As long as we can show that you have $800,000 in various assets, plus closing costs. So let's say closing costs are $15,000. As long as we can verify that you have $815,000 in assets, you qualify. It's that simple. No income, no 1099, no profit and loss. The reason for that is, and why we call it ATR, ability to repay, is if for some reason you were to stop making your mortgage payment, we know that you have the assets to back it up, the collateral to back that up in order to pay this mortgage off in full if you had to. Okay, number 6 is what I call no ratio. Now, a terminology you may have heard is debt to income ratio. Now, for a traditional mortgage, we have to verify your income and your total debts, and there's a certain debt to income ratio that we need to abide by. For this no ratio product, we are not looking at tax returns. We are not looking at anything related to income. The key to this is you have to have a minimum of 25% down payment, and you have to show that you have 9 to 12 months of whatever the monthly mortgage payment is going to be on the house. If you can show those two things, 25% down and some good reserves above and beyond that in order to make that payment for 9 to 12 months, you qualify. That's it. Super, super simple. And the beauty of this is you can have a credit score as low as 660 in order to get this loan product. Okay, so let me give you some other general criteria around most of these products. Now, some of them, like the bank statement product, allow you to purchase a home with as little as 10% down. Now, when you go back to the last one we talked about, no ratio, that requires 25% down. Assume that you're going to need 10 to 30% down, depending on the loan products that I talked about today. Now, most of them allow a credit score as low as 600. But for the most part, figure 660 and above in order to have access to most of these products. Now, the other thing is you can go up to roughly about a $4 million loan amount for most of these products. So this is not subject to a house at a lower price point. These are very capable of buying into the $1, $2, $3, $5 million price point and being able to use most of these products. So as you can see, aligning yourself with a creative lender like myself, there are products out there. Now, if you're going to go to your normal big box bank and ask for these, they are going to not know what these are, nor are they going to have the ability to do these. They're going to ask for your standard 2-year tax returns. Now, something I get told a lot from clients that get referred to me is, Beny, I went there and they said, I need to not claim as much expenses to show a much better net income in order to qualify, and then come back to them and they're willing to help. Now, you have to remember, you can go that route, but that means you're going to have to pay a lot of money to the IRS, and you might have to do that for 2 years in a row in order to do that. Now, these products that I'm telling you, while they are creative, are going to yield an interest rate that is a little bit more than a traditional mortgage. The reason for that is these are creative loan products. But in the end, and how I consult my self-employed clients, is you might be paying 0.5% or even 1% more than what a traditional mortgage is on your interest rate. However, the amount of money that you would have to pay the IRS to show enough income on tax returns in order to get the best possible traditional loan rate out there, when you run those numbers together, it just doesn't pencil. This is why when I'm talking to my clients' accountants and explaining these products, they love this. You get to continue to expense as much as you want, or even show little income and less money to the IRS. It pencils more to pay a little bit more in your interest rate and be able to buy a home. This is your opportunity to not just create another expense, because you get to write off mortgage interest and property taxes and things of that nature, but allows you to build wealth through another pillar other than your business. This is your way to use leverage to create wealth and equity in a house through these types of products. So don't let anyone tell you, no, you can't buy a house because you own a business. There are so many options out there, and I want to help you. If you want guidance through this, if you want me to help you align with the right product that fits your situation, that's going to be able to buy a house, I want to help you. So in the description below is how you would get a hold of me. Essentially, it's going to consist of a discovery call to find out what your situation is, and I can better guide you through these products. If you like this information that I'm giving you today, please subscribe. I'd love to know your situation. Comment below or reach out to me. Let's go over what your situation is and I can better guide you. Everyone has a different setup, and the idea around this is creating a custom strategy for you to be able to get into a home.